Hello, everyone, and thank you for joining us today. Today, we have with us Talia Sessler, Chief Corporate Development Officer and Investor Relations of MAXO. Welcome, Talia.
Hey, Corey. Welcome, everyone, and thank you for joining this fireside chat on MAXO.
Thanks so much for being here. Would you mind giving us just a brief overview of MAXO?
Sure. So for those of you who do not know MAXO, we are Israel's leading extreme value retailer of everyday essential, and we offer a broad assortment of quality products for customers' everyday needs, always at affordable prices. Just think of Dollar General in the US or B&M Home Store in the UK, the same thing, but in Israel. We're present now in Israel in 55 locations across Israel, and we are one of Israel's favorite brands, founded about 18 years ago.
Great. Talia, can you discuss the health of the Israeli consumer? How is the Israeli consumer positioned in the current environment, and what are the different headwinds and tailwinds the consumer is facing?
Sure. Get this question often, and that's obviously an important one. So listen, today Israel is in a better position compared to many other developed economies. Think about the US or other large global economies. We're having relatively strong macroeconomic fundamentals. Inflation is relatively low. It is trending around 4%. And we don't yet see major signs of economic slowdown in Israel, despite the modest inflationary pressure. That said, everyone in Israel, all retailers, agree that 2022 is not a normal year, and we had 2020 and then 2021, and all COVID affected, and 2022 is not a normal year as well. And we, too, are witnessing some softness in demand. However, we think that given our counter-cyclical attributes as an extreme value retailer, we could benefit from this environment, or at least offset some of the potential impact.
Great. How do you view MAXO's positioning in the discount retail space within Israel?
Yeah, so as I said, 18 years ago, we were founded by Ori Max. And since then, we evolved MAXO into Israel's leading extreme value retailer. And really, we have a simple secret sauce that is to provide our customers with the right product at the right price, at a highly fun and enjoyable shopping experience. And by the right product at the right price, I mean that, the first price is the right price. We are rarely on sale. You won't find a certain category, 15% discount this week, and then, the next week we put up the price up. We always put the best possible price first, so our consumer know they get the best deal from day one. Obviously, this is all within the margins that we need to make the business profitable, and also occasionally having some discounts in order to properly manage our inventory. And I think the other part that is not less important, that really differentiates us, is a unique treasure hunt shopping experience. It is really what makes us fun. So we always have something new in our stores, something fresh, and it creates excitement in our stores. And it's always at great prices. So holidays, for example, in Israel, they are a big part of our economy. We say we have 12 seasons in 1 year. Each month really brings ample demand. It can come from, a combination of the Jewish, the Muslim, and the Christian festivals. The Israeli population is young. The lowest median population age, if you compare, for example, with the EU and also with other countries. And Israelis simply love to shop. They're very good consumers, particularly when the price is good. And they love shopping our stores. And they made us into one of Israel's favorite brands. And that was done almost exclusively by word of mouth.
Great. Can you discuss the drivers that should lead to continued same-store sales growth ahead over time, and which categories have witnessed positive momentum recently? And how are you planning the business from a category perspective?
Okay, so I'll address this via two separate answers. The first one is really more on the same-store sales, which is a very important one. So as we've done in the past, we intend to continue increasing our same-store sales by increasing our basket size and by increasing our traffic to our stores. We don't speak about conversion because it is very rare to have someone enter MAXO store and not having and not buying. So we have our conversion is way up there. So in terms of the basket size, we are now opening larger stores that can carry wider selection of categories and broader assortment of items in each category. Just an example, we have our flagship store in Rishon. It has by far the largest basket in our chain, and it is one of our largest stores. Now, in terms of the second part, increasing traffic, really what we need to do is further enhance our brand awareness. And it is surprising that even today, some people still don't know us. And some people still have this perception that discount store is dull, it has inferior products, and they don't want to enter a discount store. However, once they try our stores, they realize that it's actually a great store, that we have great products at great prices, and they come back again and we have an extra customer. And this macroeconomic environment actually helps us get more traffic because people trade down, and some people who would not enter our store are actually coming. But on the other hand, the basket size can be negatively impaired. Overall, we think that the potential increase in traffic could definitely offset the potential decline in the basket size, and could be even more important, among the two. Now, addressing your other questions on the categories, we have an extensive selection of merchandise, probably one of the widest you have if you compare to any dollar store. And we have 6 major categories that we report on. It's houseware, toys and baby, office and school supplies, consumables, basic apparels, and arts and crafts. Now, you saw, like other investors, that our houseware category, which is our largest one, almost 30% of revenue, was down this quarter, really negatively impacted by the timing of Passover. And we expect to see a rebound in this category next quarter that should offset this timing-related contraction. And while growth in this category typically remains fairly steady and more like a mid-single-digit growth, we have seen double-digit growth in several other categories, like consumables, arts and crafts, office and school supplies, and apparel basics that continue to add to MaxStock growth story. These are seasonal growth, so definitely change versus via quarters. But overall, we are seeing strong growth in all our categories.
Very helpful. Can you walk us through the puts and takes that you see ahead in gross margin?
Yeah, sure. So on the gross margin, obviously, as you said, there are puts and takes. On the positive side, the most immediate term area of potential relief is in shipping costs. This was by far the item that impacted us most, and we are seeing some moderation in shipping costs as this year progressed. Also, there are some opportunities in procuring inventory at lower prices. You have heard about various players that got stuck with excessive inventories. We were able to be ahead of the curve. We stocked up on inventory early, and we are now in a potential spot that we can actually benefit from buying inventory at favorable prices. And maybe finally, the Israeli government, in order to reduce the cost of living, had initiated some removal of tariffs. And roughly 50% of our products are imported, and 90% of the imported products, roughly, carry custom ranging from 6% to 12%, which is now relieved. It started somewhere in the middle of May and should be in effect until the end of this year. So that's another relief. And we are also benefiting from some inventories that we bought in prior periods. On the other hand, logistic costs are still higher than what we used to have and than what we want to have. This is also a reflection of carrying a larger amount of inventory and a broader selection of items, which we will adjust. We also have some appreciation of the US dollar, but so far, the two items that I mentioned, the logistic cost and the US dollar appreciation, are significantly lower than the benefits that we are seeing as of today.
Great. On SG&A, how are you thinking about cost mitigation initiatives to enhance profitability as we look ahead?
Yeah, so in SG&A, really our two largest cost components are labor costs and leases. So labor costs, we monitor very closely on a daily basis, and we are trying to make sure that they are aligned with sales per square meter. If we see some softness in this front, we will make the necessary adjustment. So it is a lot of it is up to us. And regarding leases, we do see some potential for securing long-term leases now at favorable terms. So these two most important items could be amended if necessary. And as I said, leases could potentially be in better terms going forward.
Great. Can you provide more color on the company's inventory balance and how the company is positioned going forward in the current supply chain environment?
Sure. So, as I said earlier, in the past, we were among the first players that stocked up on inventory to make sure that we are well positioned and that we would not have any deficiencies in inventory. Because this is the worst thing, having people walk into your store and no inventory to sell. And the global supply chain challenges had negative impact on many of our competitors. So we were good on that front. And we were earlier in the sense of starting to stabilize inventory and not to build too much of excessive inventory. As I said, this could also be an opportunity for us to buy inventory at attractive prices from others. Overall, we do not anticipate any further building up of inventories. We expect inventory levels to remain stable at what we had in March this year, and potentially go down.
Great. Can you remind us of the company's plans regarding international expansion and the opportunity that could lie ahead? And can you also perhaps provide some details around the strategic rationale for expanding into Portugal and Spain? It seems like a really exciting opportunity.
Thank you. So as part of our growth strategy, we've evaluated many countries in Europe, not just Portugal and Spain. And we saw several attributes in Portugal that made it an attractive market for us. First, it's a large enough market for us. Okay, it's not the largest market in Europe, probably small for the larger players, but for us, it's large enough. Around slightly over 10 million live there. And when you look at the discount market competitive landscape in Portugal, it is relatively still underpenetrated. So discount roughly in terms of penetration is 10 to 15% in Portugal, while in Europe overall it's 23, 25%. And particularly when you compare it to the UK or Germany or Netherlands, they are much more advanced. So really this combination gives us an excellent opportunity to be one of the first entrants into this market. And several other attributes that are attractive are the wage in Portugal, which is low compared to rest of Europe, relatively low. So this is attractive both from a cost perspective for us as an employer, but also from a consumer perspective, because people are really price sensitive and they are looking to find discount offering which are not there. So that can give us a lot of added value in Portugal. Now, if we are successful in Portugal and we will expand into Spain, then that's a huge market. So Spain adds another 47 million people, and it can be served from the same supply chain. And if you add just the number of tourists that visit Spain on an annual basis, that's like roughly 100 million people, you can understand the potential. And one thing I also forgot in terms of attributes is the logistic costs that are very low in Portugal. They're very advanced in terms of logistic centers. So you don't have to invest in building your own logistic centers. You can get third parties at very attractive prices. And particularly for us, having a strong supply chain from China, that's another advantage.
That's great. And it certainly seems like quite the interesting opportunity. So thank you for all that color. How is MAXO addressing higher logistics costs and freight headwinds? And can you discuss the impact on the company from the lockdowns in China?
Okay, yeah. So on the logistic costs and freight, well, first think about our products. Around 70% to 80% of our products are less than 20 shekels. So we are like 6 below in most of our products. And this really helped us keep our gross margins relatively stable, despite the headwinds from higher logistic and freight costs, because we were able to adjust our mix and to focus more on lower size items, smaller packs. It's easier to do when you have so many SKUs. You can change the size, you can change the pack, you can change the particular SKU and price it slightly different in order to make sure that your gross margins will maintain steady. And going forward, as I mentioned briefly, in order to be efficient with logistic costs, we are making some adjustment to the number of our SKUs because we feel that currently we carry excessive SKUs that do not contribute much to sales. We have to optimize that, and that can actually improve our logistic costs. In terms of China, our relationship with suppliers in China and our ability to be ahead of the curve in terms of inventory management were two major advantages for us in the past 2 years, while China has been closed. Unfortunately, we got used to lockdowns in China, and we can continue to buy remotely from China, but it does have some negative impact on our ability. I spoke about our secret sauce. The first element is the right product. And when you buy remotely, you are not that precise. So that is something that has been impacting us. At the same time, Europe is now opening up, and there are opportunities to buy inventories at attractive prices from others. And sometime China will be open. So overall, we think we should be in good shape, even if China remains closed for the next year or so.
That's great. And how does the company plan to manage cash and drive returns for shareholders ahead?
Yeah, so that's another question I get very often. We have ample liquidity. We have relatively for our size, right? So we have like 60 million in cash. It can ensure financial flexibility, support future expansion activities, and also our debt levels are very modest. We have about debt of almost 80 million. These are all figures as of the end of Q1 this year. So, There are various angles, I would say. The current environment really favors strong players with deep pockets. And when you have this financial flexibility, you can seize opportunities as they arrive. So we like this financial flexibility and potential. We may leave the capital allocation a bit unoptimized, just in order to make sure that we can make sure we seize the opportunities once we see them. However, we understand that investors want us to have an optimized capital allocation, and if we decide that indeed there is an excess cash, we will distribute it to our shareholder one way or the other, as we did last year. There isn't any concrete plan or policy at this point that I can share, but as soon as we have something, definitely this will be published.
Great. And then lastly, can you provide details on the company's long-term growth algorithm?
Yeah, so that's part of my role as a corporate development officer, and a lot of work is being put into building various growth angles. So the more I would say the basic growth algorithm is, driving our annual revenue growth in the low to mid teens through the combination of opening 3 to 5 new stores per year and increasing same store sales by approximately 3%. This is long term. This year, we will have lower same store sales, but longer term, we think we can certainly get to this target. And in terms of opening new stores in Israel, we said in the past we see a potential for a MAXO store in every city in Israel that there is 30,000 people or more, and there are 60 cities in Israel with such population. We're only present in half of them, so there's ample white space opportunities still ahead of us. And we are on target in terms of our plan. Plan is to double our square meter count in Israel versus what we had in 2019 over the next few years. So we're currently at 55,000. We expect to end this year at 60 and reach 80 in 2 to 3 years. And if we look historically, since 2019, we've increased our net square meter by almost 40%. And there was no cannibalization as a result of this increase. Rather, our sales per square meter actually went up by over 20%, which is a great combination. And if you add to that, the planned expansion beyond Israel that we've discussed and additional growth engines that we are evaluating, we feel that we have a very long runway for long-term and profitable growth.
Great. Well, those were all the questions I had. Again, I am Corey Tarlow, specialty and discount retail analyst here at Jefferies, joined by Talia Sessler, Chief Corporate Development Officer and Investor Relations of MAXO. Thank you so much again for being with us today, Talia. And I'll leave you to leave any closing remarks for the audience.
Well, first, thank you very much, Corey, and the entire Jefferies team. It's a pleasure working with you, and I wish you a great and successful conference. And that's pretty much on my end.
Great. Thank you so much, everyone. Have a great day.
Thank you.